Hey, you guys, thanks for listening in to this episode of Tips with T. On today, I have Mr. John with us. Hey, Mr. John, how you doing today?
Hey T, I'm good. Thanks for having me.
Thank you so much for being a guest on the show today. But before we dive into our topic of the day, tell us a little bit more about yourself and what you do.
Absolutely. So I am a chartered financial consultant, which is a designation from the American College of Financial Services. So I am a fiduciary financial planning professional. And I like to describe my practice as life insurance product centric planning. We tend to use life insurance products as the foundation for most of our financial planning activities.
Awesome. And I'm glad we're having you on the show today to talk about this because this is a topic that tends to go under the radar a lot. Like people tend not to want to talk about it. They not want to deal with it. But what made you decide to get into the insurance industry?
So that part of my story goes back quite a ways. In the late '90s, I worked for a company and was in the right place at the right time, and had some stock options in an employee stock ownership plan. And the build up to the tech bubble bursting in early 2000, we was all going to be we were going to do an IPO. The company was going to go public, and it was all just going to be amazing. And then the bubble burst, and that didn't happen. So I took the money that I had left after that in the employee stock ownership plan, and I did some calculations and realized I was going to be kind of exposed to some taxes later on if I didn't do something different. So I bought a piece of property in Southwest Washington with the intent of subdividing and building spec homes on it, and I did that. And I was about halfway through the first spec home when 2008 came along. And so the market conditions and, of course, some mistakes that I made at the time, that project also imploded. And so in the aftermath of all that, it was really some kind of dark days for me personally. But it was also a wake up call. And so I started reading and studying a lot of information, books and blogs and so forth, everything I could get my hands on, both about life in general and a lot of financial information. And in the course of that research, I was on a webinar one night, and this advisor was walking through this example of a couple and some home equity, and he started talking about a life insurance policy that was building up cash value over there over time. And it was the first time I was exposed to the idea that life insurance could be something more than a death benefit, that there could be some other purpose to it. And so from that experience, that led me to really two other books that were pivotal. One was R. Nelson Nash's book, Becoming Your Own Banker, and the other was Pamela Yellen's book, Bank on Yourself. And so both of these describe a concept of using properly designed whole life insurance contracts as a wealth building platform. And so I set up my own policies. I met with an advisor and got my own policies set up and started using them. This would have been back in about 2009-10 timeframe. And I got very, very passionate about it. And I realized that I'd been to so many financial advisors and none of them had ever mentioned anything like this. And I was ready for a career change, and I was really passionate about this life insurance concept. So I decided to start my own practice and share this message with others. So I launched my practice in 2012 after getting licensed and completing a lot of training, and I love what I do.
Awesome, awesome. So I'm glad, like I said, you are here to talk to us a little bit about that today. So, um, you mentioned that at the beginning about how life insurance should be a part of the financial planning part. So, why is that so important? Why should we, try to include our life insurance planning with our financial planning?
Well, so one of the reasons it's really important and what goes overlooked, I think, in a lot of planning is accessibility. We need to have accessibility to at least some of the money that we're putting away. The statistically, a significant percentage of American households can't meet a $400 extra expense without having to borrow money to do it. So that's not a good situation. And so I think we can use life insurance as a place to build up liquid cash. It can be part of the financial plan, part of the retirement plan, but it's that part that's really safe. It's not exposed to any market losses. If the stock market crashes next week, the cash in those policies is going to continue to grow by a larger amount every single year, no matter what, really. And so it's protected from those types of events. And it's also accessible. We have access to it. If that $400 emergency comes up, we have some place to grab cash without breaking into a retirement account that's going to cost us penalties and taxes and so on and so forth. So that's why I think it's a really important piece, is that accessibility, the ability to get your hands on that savings if you need it in an effective way.
Awesome, awesome. Um, so how can we use life insurance as an investment vehicle? Because like a lot of people don't know, like this is fairly new to people. They don't know that it can be their own bank and stuff like that. So how can we use it as an investment vehicle?
So I think it's important to make a distinction that a life insurance policy is not an investment in and of itself.
Mm-hmm,
So there are most people are familiar with term life insurance. So term life insurance, you pay your premium for a period of time, 10 years, 15, 20, whatever it is.
mm-hmm,
And you have a death benefit. So if you died during that 10 years, then your family will get this death benefit. And it does serve a purpose, of course.
mm-hmm,
But it doesn't build up any equity.
mm-hmm,
So the kind of life insurance that we're talking about is permanent life insurance. So high cash value, low commission, dividend paying whole life insurance is the product that I specialize in. And with a whole life insurance policy, as you pay your premiums, there, first of all, there's no set term. It's called whole life because it covers you for your whole life.
mm-hmm,
And so as you pay these premiums, they build up cash value within the policy. So they provide a death benefit, just like term insurance does, but they're also providing a cash value buildup. Now, a lot of people are familiar with kind of the old school version of whole life insurance, where that cash value buildup is pretty slow. It could
mm-hmm.
take years and years and years to really build up a meaningful amount. But we don't do that anymore. We use what I call modernized whole life policies, which are designed to accumulate that cash much, much, much faster.
Mm-hmm.
Even in the very first year, we're accumulating significant cash values. And so, as we build up the cash values in those policies, we can use what are called policy loans. So, we have the ability to borrow from the insurance company using these policies as collateral. And that's how we can use them as part of the investment approach. So, a whole life policy, from my point of view, is not an investment in and of itself. It's a system. It's a system for saving, borrowing, and investing.
Mm-hmm.
So we can use the policy to facilitate, to make investments, and we get the benefit of both the growth in the investment and the growth in the policy simultaneously.
Awesome, awesome. And I noticed too, like a lot of people, they're trying to get away from whole life policies, but I still try to tell people, well, if you want to get a term policy, that's fine, but still have a whole life policy because what if the term policy expires and you're still here and you don't have a policy to cover you? Because I've seen that happen a lot. Like some people outlived the term policy, didn't renew it in time, but if they would have had a whole life policy just to cover the expenses, they wouldn't have had to pay out of pocket. So it's like you don't invested all this money in a term policy that's no longer beneficial, like because it's expired, like it went past its term.
Right. And the cost to renew is often many times higher than the original cost. So if you take the term policy out when you're 30
Mm-hmm.
for 10 years, when you're 40, that premium is going to go up substantially. And actually, I meet with people all the time in their 60s and 70s whose term policies are expiring or have expired, and
Mm-hmm.
the ability to renew, the costs are so high, most people just don't.
Yeah.
And so that's another great reason to keep whole life in place, so
Mm-hmm.
that again you're covered for your entire life and you're not dealing with that situation.
Yeah, awesome. I'm glad you said that because I was chatting with another particular lady. I was like, well, what happens when the term like policy expires? Like, what happens then? Like, and it was like it's a renewal, but like we didn't really go into depth about um the premiums and stuff goes up and the cost of this goes up. Where like you said, with a
Mm-hmm.
whole life policy, once you're locked in, that's it. Your rate does not go up. It stays the same rate your whole entire life. And I try to tell people to get those policies while you're young. Because if you get those policies while you're young, they're cheaper and you just pay them for the rest of your life and you don't have to worry about, getting a term policy that's gonna term out and trying to renew
Mm-hmm.
it. And then when you renew it, you're renewing at a higher rate. So I'm glad you did come up here and share that because a lot of people don't know that. They do not know.
Yeah, absolutely. And I'm glad you mentioned about start it sooner than later.
Mm-hmm,
There's a proverb somewhere that says the best time to plant a tree was 20 years ago. The
mm-hmm,
second best time is today.
mm-hmm,
Right. So just get started, I think is super important. That doesn't mean that folks out there listening that might be in their 50s or 60s or even 70s can't make these types of policies work. They can,
yes,
absolutely. But I know, like when I found out about this, one of the first things I did is I went back and looked at that real estate project that didn't go very well.
mm-hmm,
And I ran some numbers on what if I'd have taken the money from that ESOP and put it into a whole life policy and used it to develop that property. And it
mm-hmm,
really would have made a huge difference if I had just known about it. So a lot of
mm-hmm,
people find out about the concept and they go, oh man, why didn't I know about this when I was 25 or
mm-hmm.
whatever the case may be? So absolutely get started sooner rather than later, even if you have to start small and build up.
Yeah, that's what I tell. That's why I try to tell people like just start small. Like I even try to tell some of my clients like when they have young kids, get them a whole life policy while they're young. Like don't wait till they get a certain age. And my dad taught me that because my daddy he has a whole life policy on me that's paid up for the rest of my like it's already paid off. Like you don't have to pay nothing else on it because he started so early. He started when I was an infant, and just those type of things can be like beneficial. Really can be beneficial.
For sure. And what a gift to give a kid, right? When they
Hmm.
when they reach adulthood, they've got this policy that's been building up since they were little, and so it's just a great thing to pass on.
Awesome, awesome. Well, thank you, Mr. John, for being on the show. Coming to share your tips and stuff about life insurance policy and financial planning and how that all plays a role with one another. So I'm going to share your social media handles and your website and stuff. Um, and I want you to tell our listeners how they can get in contact with you. What if you have anything going on during this time that you want to offer, you can feel free to share.
Absolutely. So the best way to get a hold of me is on a page that I have set up called jumponwithjohn.com. That's JOHN John, jumponwithjohn.com. And what I always recommend is just speak to someone about these things, someone that isn't going to push or sell you on something, but really just provide an education. And that's my promise. If you set up a free strategy session with me, if you go to that page, you can jump right into my calendar and schedule 30 minutes absolutely free. And my promise is I'm not going to be pushy or salesy or any of that. I'm just going to have a conversation and see what's a good fit and whether I can help. So jumponwithjohn.com is the best way to reach me.
Awesome. And he's also on the other platforms, you guys, as far as Twitter, Facebook, and LinkedIn, if you want to go follow him there. And if you guys want to get in contact with me, you can do so. My number is 910-317-0396. You can shoot me an email at contact@mjfinancial.biz. You can schedule a consultation with me, you guys, on my website at www.mjfinancial.biz. You can find this episode on Spotify. It's no longer Anchor, you guys. Anchor done changed the name to Spotify. And you can also find the playback for the video on the YouTube channel for M&J Financial Management. So thank you, Mr. John, once again for being a guest on the show. I highly appreciate you.
Thank you so much, T. It's been awesome.
And all right, you guys, we will see you on the next episode of Tips with T.